Hello everyone, good afternoon and welcome to today's Professional Advisor Working Lunch, brought to you courtesy of our partner Baillie Gifford. I'm Katrina Lloyd, I'm Editor-in-Chief of Professional Advisor and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. I should inform you the session is being recorded and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session. The US is the most innovative country in the world. It creates more great growth companies than any other country combined, yet its stock market indices are currently at record levels of concentration. Combine this with the noise around AI, inflation, valuations, and politics, it's easy to lose sight of the true drivers of long-term returns. The reality is that a small group of exceptional growth companies harnessing powerful societal change are the ones that produced outsized gains and eventually become the mega cap leaders of tomorrow. In this session, I'm delighted to be joined by Ben James. He's Investment Specialist Director for the Baillie Gifford American Fund. We'll explore this market concentration and the American Fund, how it identifies transformative companies early and invests in them with conviction to capture their asymmetric returns. We'll also focus on the influential changes happening in the US today, fueling the next generation of winners. And Ben will discuss how this high conviction, growth-oriented approach is positioned to benefit from the mega caps of the future and can enhance a diversified portfolio. So please, as usual, do feel free to put your questions to Ben using the chat function. You can find this just at the bottom of your screen. We do want this session to be as interactive as possible. Just before I hand over to Ben, let me quickly run you through our learning objectives for today. So by the end of this session, delegates will have learned the potential risks of investing in a concentrated index, why and how Baillie Gifford's American Fund seeks exceptional growth companies that could be the mega caps of tomorrow, how this approach can help you manage your exposure to a vitally important but top-heavy market. So that's the CPD points covered. Ben, good afternoon. I'm going to hand over to you for your presentation today.
Thank you, Kat, and I hope everyone can hear me okay. I'm really looking forward to all of you today. Thank you very much for taking this time out of your working day to join in. But first, I just want to use this opportunity to make you all aware of a key issue happening in our industry. You may have read about this in the papers, but for those of you who haven't, a US hedge fund, Saba Capital, is proposing some radical changes to 7 investment trusts in the UK. 3 of them are managed by Baillie Gifford, the Edinburgh Worldwide, Keystone Positive Change Investment Trust, and the Baillie Gifford US Growth Trust. Now, the US Growth Trust is the closed-end sister fund to the American Fund, which I'm talking to you about today. It's critical that if you, your clients, or even your friends and family hold shares in any of these trusts, that you engage with the process and vote your shares, please. The boards of each of these trusts unanimously oppose the proposals from Saba and strongly urges you to vote against them. The hedge fund is counting on voter apathy and inertia to potentially take control. So please vote your shares. Your vote matters, and I'm happy to talk more about this in the questions later. So that's my election pitch over. I'll share my screen and talk to you about the ostrich, the index, and us in search of exceptional US growth in a top-heavy market. Today, I'm going to cover the following: the concentration conundrum of the US stock market, focusing specifically on volatility and opportunity cost, the topic of valuations in the US market, and why we remain at Baillie Gifford bullish for exceptional US growth companies. I'll cover what we've been doing in the American Fund in the context of this backdrop, and then looking forward, why we remain extremely excited by the prospect of a select few exceptional growth companies driving long-run returns from here. I'll cover what we mean by exceptional growth companies, how they navigate the short-term challenges and thrive in the long run. And then I'll also finish off on what we're focusing on amidst the noise of Trump, tariffs, tax cuts, and so on. So Why am I talking about ostriches? They say you shouldn't put all your eggs in one basket, but what about putting 500 eggs in one basket, 7 massive ostrich eggs sitting atop 493 small quail eggs? That is a lopsided basket. And it also seems expensive when you go to pay for it. Perhaps it's the eggflation in the US that you've been hearing about. You've got to be vigilant on your long walk home if you need these eggs for your retirement omelette. And if the ostrich eggs move, your journey could be a bit wobblier than expected. Passive index investing has been a pivotal innovation in our industry. It's low cost. It's important in helping investors choose how to build a nicely diversified portfolio. And it puts pressure on, inverted commas, active managers who are actually just closet index huggers. This active manager, Baillie Gifford, we welcome passive in many ways. Our high growth, truly long-term, high active share approach is actually a natural pairing with passive. However, passive index funds are not currently a diversified investment. They are an ostrich egg basket. The so-called Magnificent Seven, the Mag 7 companies, dominate US equity indices. Alphabet, the parent company of Google, Amazon, Apple, Meta, which owns Facebook, WhatsApp, Instagram, Microsoft, Nvidia, and Tesla. In the S&P 500, here on the right-hand side, the Mag 7 constitute about 34% of the market. In the Russel 1000 Growth Index and the Russell 3000 Growth Index, which are popular growth indices in the US for large cap growth companies, they make up over 50% of the market. This makes for quite a skewed industry benchmark. For example, the median market cap for the Russell 3000 Growth is $2 billion, while the weighted median is $1.1 trillion. That's 550 times larger. And for context, the ratio in the American fund is 3.7 times. So our median market cap in the American fund is $14.3 billion. Our weighted median is 53.2. Which do you think has more significant upside potential from these starting points? But given the strong performance of the US indices, are investors burying their heads in the sand about the lack of diversification? Commentators suggest that market concentration presents some risks, increased volatility and opportunity costs being some major ones. And some commentators even suggest that investors should reduce their US exposure in general. So, firstly, can you ignore the US? That's a key question. On this slide, I'm going to show you the companies in the EU and in the US that have been founded in the last 50 years that have gone from being a startup to greater than $10 billion in market cap. And the circles represent their market cap size. So here's the EU. There we go. And here's the US. This visually striking graphic tells me all I need to know about the past. It has created, the US, more great growth companies than any other country combined. Now, yes, the US has indeed outperformed most other markets, this chart on the left. The blue line being the share price performance of the MSCI USA versus the red line of the MSCI ACWI, All Countries World Index, less the US. But this has actually been underpinned by much faster earnings growth in the US compared to the rest of the world. So it's been driven by overall fundamental growth. And exposure to the US, we believe, is especially important now during a time of monumental change, given the US's ongoing dominance in the technology sector and its outsized contribution to global innovation. For example, 39 of the 50 companies on Forbes's most recent list of the most promising AI private companies are US based. And we believe that the US dominance in creating exceptional growth companies is going to continue and persist for years. The reasons: the US has some of the best academic research institutions in the world and a strong talent pool for supplemented by immigration for keeping this going. It has a broad and deep venture capital system that supercharges the growth of startups, as we've seen. It has strong intellectual property protection and very business-friendly regulatory environment. And then finally, it has this X factor, the unrivaled culture of optimism, ambition, and willingness to accept failure, the American dream, if you like. And collectively, this sows the seeds for truly exceptional growth companies to emerge. So we believe you can't ignore the US, but the conundrum is the market appears very top heavy. So two of the potential concerns out there in the market about concentrated indices, volatility and opportunity cost, are what I'm going to cover next. So let's talk about volatility. At Baillie Gifford, on the US growth team that runs the American Fund, well, we embrace volatility. We live and breathe concentrated portfolios. So we're not going to thoughtlessly just criticize index concentration. We think it's a good thing. And if Professor Hendrik Bessenbinder's research on the nature of long-run returns shows us anything, it's that markets are naturally skewed. This is the wealth generated by the all US listed stocks over the last 90 or so years. And you can see that of the $35 trillion that were created, only 90 firms out of the 24,000 plus that existed generated half the wealth. We know it's skewed. In fact, we actually aim to exploit this asymmetry in our investment approach. It's the hallmark of our approach to growth investing. And Tesla is a really good example here. It's been one of the best performing companies in the American Fund over the last decade. And this is where I'm going to bring in my first poll. So I'm just going to use the technology that I was taught about half an hour ago and publish my first poll. When did Tesla enter or join the S&P 500? You've got three options: December 2018, December 2019, or December 2020. When did Tesla join the S&P 500? I'll give you folks another 5 or so seconds to complete that. So most of you went for December 2019 and 40% for 2020. Well, the 40% of you are right. December 2020. That's when it joined the S&P 500. Now, the point being is that we invested over 10 years ago when we bought Tesla. It was a plucky mid-cap company making 35,000 cars. It was $25 billion in market cap. It's now making $2 million a year, having grown production by 50% per annum for a decade. But index investors only got exposure to that growth just 4 years ago. We, by finding these mega cap companies early, had 6 more years of growth before that point. Now, the Mag 7 companies that I've mentioned are good companies. They're better than good. They are powerful, impressive. They generate incredible cash flows. They've got there mostly on fundamental growth over the last 15 years. There are 4 of them indeed in the American Fund: Nvidia, Amazon, Tesla, and Meta. For us, these 4 are magnificent ostrich eggs. They have very tough and strong shells. And if they do wobble in your basket, your journey home will be more volatile, but they are unlikely to break if they fall out. And they could get even bigger from here. So volatility is not a risk for us. And this chart here shows the VIX volatility index for the last calendar year, 24. And you can see that there's been an increase in volatility as the year has progressed, as the market became increasingly concentrated. This isn't risk per se. All we ask is for investors needing to be aware that the cheap, diversified passive index fund you're buying could be more volatile than you expect currently. Volatility for us is actually an opportunity. Our job is to seek out tomorrow's winners, select a different group of companies and ride out the inevitable market swings caused by short-term news flow and sentiment shifts. However, despite the potential rewards of this approach and the backing of our clients, we know that the volatility in the American fund returns since 2020 was beyond the expectations of many of our clients and higher than we would like to deliver in the future. Now, we continually strive to improve, and there were some lessons that we've learned from this period that we're applying to our investment process while still maintaining that outlier philosophy that we believe will drive future returns. So last year, we implemented some portfolio construction enhancements following a thorough review and methodical review to improve how we build and maintain our high conviction, high growth portfolio. We have 3 new internal guidelines in play now. They track portfolio levels of financial maturity on a trailing 3-year basis, the concentration of the sources of demand. We don't want to be overly concentrated in one area of demand that could increase correlation, and the types of growth, company growth profiles. Lots of transformational and dynamic type growers, but increasing our exposure to some more enduring high growth companies and capping our exposure to the very earliest. We've backtested this over the last 4 years, and it does dampen volatility slightly and increase performance. For what it's worth, delivered tracking error and portfolio volatility have been trending down this year, or last calendar year. They are actually now back at pre-pandemic levels. So that's volatility. Perhaps the biggest risk for investors in passive US index trackers is opportunity cost. The Mag 7's market cap of around $18 trillion poses a challenge for investors to express relatively positive views on these mega caps without allocating huge amounts of capital, a disproportionate amount of capital. For example, Apple, currently around 7% of the S&P 500, and shockingly 12% of the Russel 1000 growth. So if we wanted to put a modest 2 or 3% active overweight exposure in the American fund, that would consume 10 to 15% of the fund. Now, OIC concentration rules do not allow us to do that. We cannot go beyond 10% in one single name. So we can't actually add an active position against the Russell index. And even if we were allowed, this is challenging to significantly impact relative returns. And this chart here on this slide shows that it's long cyclical. Concentration does reverse again historically. And it should be, as you'd guess we'd say, a stock picker's opportunity. Investing large amounts in the Mag 7 may come at the expense of other potentially more promising opportunities elsewhere. So this brings me to my second poll. Nvidia has been in the headlines for its strong performance, its exceptional performance over the last 18 months. But in the Russell 3000 Growth Index, which is 1,500 of the best growth companies in America, how many companies do you think outperformed Nvidia's exceptional return in 2024? So how many companies in the Russell 3000 Growth outperformed Nvidia in 2024? You've got 12, 24, or 48 out of 1,500. I'll publish the result now. And there we go, a third each really. The majority think that it was 12. Well, actually, it was 48. In an index where the Mag 7 make up over 50% of the benchmark, strikingly, 48 returns surpassed NVIDIA's remarkable return in the 12 months to November last year. And 457 stocks, so a third of the index, outperformed the median return of the Mag 7. So this tells us that for those looking for upside, there's ample opportunities to outperform the index and exceed the returns of the Mag 7 and even NVIDIA. So NVIDIA was one of our top performers last year, but the top relative contributors in the American fund beyond NVIDIA were programmatic advertising platform The Trade Desk, online food delivery company DoorDash, Netflix, the streaming platform, the fast casual salad chain Sweetgreen, and e-commerce platform Shopify. Now, these 5 companies are approximately 30% of the portfolio. Their overlap with the S&P 500 is 0.8%. So an important question I would like attendees to go away with today is, and for investors in passive index funds, is the Mag 7 group today, will they be at the top in 10 years' time? Some might be, some might not. Remember, Tesla only joined the S&P 500 4 years ago. What matters to us is that we are actively hunting for the next generation of mega caps, the next NVIDIAs, the next Teslas. So that's opportunity cost. Let's talk about valuations. Linked to opportunity cost is valuation risk. The question we need to ask is, within a passive index fund, are there some expensive but past their sell-by date eggs in this ostrich egg basket that is the US index? There probably are. It's tough to see, the ostrich eggs are so big. And passive is a package deal after all. Let's have a look at the numbers and see what it tells us. This chart shows the breakdown of the return composition for the American fund on the left, the S&P 500 in the middle, and the Russel 1000 growth on the right for 5 years to the end of November 24. And it breaks down the return, the total return, by multiple expansion in pink, fundamental growth where the multiple has stayed the same, so the value ascribed to a company stayed the same, but the fundamentals have improved, dividends in light blue, and then activity, so trading in the portfolio in grey. And this is striking to us. It shows that the market has had about nearly 40% over the last 5 years of its return driven by an increase in price to sales. So it's become more expensive. Whereas nearly 80% of the American fund return has been driven by fundamentals. About 7% has been from activity, so trading, and only 13% has been on valuation increase. This is what we want to see as bottom-up stock pickers. We have to be clear that this pattern shifted somewhat in 2024. Valuation expansion has been driving returns pretty much broadly across all of US companies this last calendar year. And this is a trend we've been watching very closely, particularly since November's election result and the rally that followed. But critically, like a passive index, we monitor this as part of our ongoing processes and, where necessary, adjust the portfolio. So how are we thinking about this valuation of the risk, and what are we doing about it? Well, for us, it's all about expectations versus upside. Research suggests that returns follow fundamentals over the long run, 5 years and beyond. And the stock market rewards companies that deliver the greatest profitability, the greatest earnings growth. It also shows that investors can find the greatest returns in companies where the market does not anticipate or appreciate that growth. So it pays to think differently and have a different exposure to the market. Now, this table, this matrix here shows a couple of things. On the horizontal, we have So the x-axis, we have the estimated earnings growth quintile. In layperson's terms, splitting the market into what, say, 3 years ago, the market expected the quintile for its earnings to be. So top quintile, top 20% in 3 years' time, this company would be in this one, for example. And on the y-axis, on the vertical, you've got what these companies actually did. And this shows us that, for example, companies that were expected to grow in the top quintile of profit growth and that actually delivered that subsequently delivered on average a 13% return per annum. But if you were in that top 20% forward estimated earnings growth, but delivered the bottom 20% of returns, your average 3-year total return was minus 6% per annum. So you disappointed the market. And then if you look right over here, the top right, those that were in not expected to grow the most, but did grow the most, delivered 23% per annum. Now, 5 years ago, Nvidia and Tesla weren't in this top 20% forecasted earnings growth. They were substantially smaller. They had these evolving addressable markets and uncertain growth and profitability futures. However, exceptional operational progress has meant that they delivered returns for Nvidia of, over 2,600%, for Tesla 1,500%, which has taken them into the Mag 7 roster. And this starkly contrasts with the much larger and more mature names of Apple and Microsoft, where multiple expansion has made a meaningful contribution. So our philosophy focuses on identifying individually unlikely but rewarding opportunities we think are materially undervalued, these exceptional growth companies. And part of our analytical framework is building conviction in companies' addressable opportunities relative to its current size. And through this lens of asymmetry, we are positively disposed to companies earlier in their growth journey, companies with the potential for greater upside. And the opportunity for the greatest relative returns lies where we think we have sufficiently differentiated insights. And that is reflected in our portfolio construction. We have a very, very low overlap with US stock indices. For example, about 15% only overlap with the S&P 500. And yet, you can see the percentage of weight in the forecast sales growth 1 and 2 quintiles, or earnings growth 1 and 2 quintiles for the next 3 years is significantly higher than the S&P 500. If they can deliver on that, we should, theory suggests, outperform. Now, earlier I did a disservice to the ostrich. So apologies to any ostrich fans out there. Ostriches don't actually bury their heads in the sand. Instead, they carefully, diligently, and regularly rotate eggs in communal nests dug into the ground. They co-parent eggs and their nest. They work as a team to ensure the best chances of success. And if you'll allow me to stretch this metaphor to its conclusion, we haven't been burying our heads in the sand either. So we've been checking and adjusting the holdings based on their maturity and the probability of becoming massive from here. Over the last year, we've harvested gains from Nvidia several times to fund other investments where the growth opportunity is at an earlier stage, asymmetry is more pronounced, or we have growing conviction in the upside. We've been monitoring all holdings that have performed well this year to check their upside from here, especially since November and the rally post President Trump's election. And most recently, we made a notable reduction here to Tesla. It saw a significant share price increase post November the 5th. And we reinvested most of this proceeds into a new holding up here, DraftKings, the online sports betting platform. DraftKings is a $20 billion company growing revenues at 40% year on year. And at the time of the trade, Tesla was over $1.1 trillion in market cap, growing sales at 1% per annum. Now, that is impressive in the context of its challenged industry nonetheless. But DraftKings valuation was at a discount to the US growth indices on an enterprise value to sales basis and lower than Tesla's. Now, I'll touch on valuations again in a bit. Inevitably, not all our ideas succeed. We sold Coursera, the online education platform, in the last 3 months. Education and training are substantial global opportunities, but Coursera's revenue growth slowed, and it had de-emphasized the importance of its degree business, which we had as a key part of its forward-looking hypothesis. But we recycled those proceeds into a handful of companies where we believe growth is underappreciated. Medical instrument pioneer Penumbra, refrigerated transport and storage leader Lineage Logistics, edge computing security software provider Cloudflare, online home furnishing platform Wayfair, and product and technology design company Shark Ninja. Now, the average market cap of these companies is $16 billion, and their overlap with the index is close to zero. Their average growth rate is 16% per annum, 20% if you exclude Wayfair. Now, what about Trump? What about tariffs and tax cuts? Well, insert your concern here. Excuse me. This chart is one of my favorite charts. It shows the Fed funds effective rate in blue, and then in purple, the futures market's expectations at that point in time. The point, nobody knows nothing, to quote one of my colleagues. No one is able to predict accurately what is going to happen in the short run. So what can you do? Well, what we do is seek out exceptional growth companies. They, in part, look after these risks for us and for you. So what do I mean by exceptional growth companies? Some characteristics are relatively straightforward. They address huge market opportunities at an early stage. They have a sustainable competitive advantage and an effective culture. But a few other things really matter, and really matter for the short term, for example. They need resilience to navigate the short term. They need adaptability to negotiate and navigate the long term, allowing a company to unlock its long run potential. And yes, they need to be on the right side of monumental change. So let's look at resilience, navigating the short waves. Companies may address huge opportunities, but if they don't survive, they can't thrive. So they need to survive macro and economic volatility. So you need financial strength and ability to transition to self-sustainability. Long-term supportive shareholders like us who can provide capital and a more stable shareholder register, and this clear vision so that understanding of what the company is trying to do and keeping that vision in mind when making shorter term choices. It also means facing off against competitive pressure. So companies need a clear differentiation, whether in their product, their go-to-market or business model, ensuring that its advantage versus competition grows stronger over time. So let's look at resilience in the American fund, the indices and us. Our portfolio characteristics are encouraging relative to the US market. On valuation, returning to that, we've actually seen the portfolio's enterprise value to sales ratio decline slightly from February this year. In contrast, the same ratio in the S&P 500 has increased to the end of November. On the same basis, the fund is on a 46% premium to the S&P 500, as we would expect, but actually significantly lower than December 2023. But critically, forecast to grow 112% faster than the S&P 500 for the next 3 years. And if you look at the Russel 1000, 3000 growth indices, we're actually at a discount on an enterprise value to sales basis by around 5%, but forecast to grow up to 16% faster for the next 3 years. The portfolio is generating significant earnings and or free cash flow, or has long runways of cash for the small tail that is not producing that. It invests significantly higher in R&D than the index. And this is a strong indicator of future long-term returns. It has a net debt to equity, i.e. that is negative, i.e. it's net cash versus an indebted market. Now, much of the current focus in the market is what Trump 2.0 presidency will bring. Is it noteworthy then that the American fund has a much lower revenue exposure to Asia, 10% versus the index is 20%, or a higher exposure to the US, 70% versus roughly 55% in the S&P? This might help insulate it against any tariffs, maybe. But the truth is, remembering to that graph of the Fed funds rate, no one knows. What matters more is that your companies are financially resilient, that they address long-term structural demands and are run by visionary long-term leadership teams. Now, navigating the long term is all about adaptability, about retaining fitness regardless of the environment. And this chart brings to life a study from a few decades ago actually, by the McKinsey consultancy group, that found that the 30 most successful companies had business strategies all about adaptability, and they balanced what's known as short jumps with long jumps. The short jumps were the ones you make where you know precisely where you're going to land, and the long jumps where you take off with a vague sense of where you're heading. They called this the 3 horizons of growth. So horizon 1 is the business today, the core of the business which today generates the most profits and cash flows. Now, growth here is about extending the duration of this existing business, improving performance and maximizing remaining value. So let's take an example of Duolingo. I expect some of you on the call will use the language learning application Duolingo. Duolingo's Horizon 1 is the addition of new languages to the app, adding new languages to broaden its potential user base. Horizon 2, the middle one here, encompasses emerging opportunities that leverage existing opportunities. These are medium jumps. They require some more effort for sure, but it's about time and investment. So for Duolingo, this jump is all about incorporating generative AI on the app. They've done this and they've enabled the company to offer a new subscription tier with a higher price element that contains additional features engaging with an AI teacher. Now, Horizon 3 is about ideas for profitable growth way down the road, these long jumps that plant the seeds for new businesses that don't exist yet. For Duolingo, this is the move into things like music and maths. And the most intriguing thing about this study from McKinsey was that the best growth businesses tend to balance across all 3 at the same time, whereas the average company focuses on Horizon 1. And that makes sense because Horizon 1 is lowest risk, likely to pay off in the shortest time horizon. They feel more comfortable. But if you only make these same jumps again and don't evolve and adapt, you lose any ability to flex the size of your jump and adapt to how the world is shifting underneath you, a crucial component in long-term investment. And to bring this back to the index, we think the index is only focused on Horizon 1. And as for that third characteristic, monumental change, underpinning all of these 3 different horizons is the monumental change that education is being digitized. Duolingo is disrupting traditional education models by harnessing new technologies, the internet, mobile, AI, gamification, social media. This is because we like to find companies where change is driving growth. We think that's the most powerful thing that we need to identify. So we go about it by looking at certain models. The idea here is that companies don't exist in a vacuum. Their fortunes are tied to levers and tailwinds and headwinds within the ecosystem. For example, Motorola invented the first cell phone, first mobile phone back in the 1970s, but the system wasn't ready for it. Nothing really happened for 30 years. And so looking for change within a system is really exciting, and you can potentially find some fantastic investment opportunities. The knock-on effects within the system are quite hard to predict, and it tends to surprise. Going back to NVIDIA again, NVIDIA is tracking about $130 billion in revenue in 2024. If we go back just 24 months, its forecast was worth $35 billion. So the financial services industry missed top-line results by almost 4x and $100 billion in just 2 years. And this fundamental growth wasn't tied to a cycle or rates or inflation or an election. They're tied to massive change happening within the system. So we use models to identify change in a system that we can apply to our investments. This one is called pace layering by Stuart Brand. He breaks society down into 6 layers, from fashion to nature, you can see here. Each layer changes at a different speed. Fashion is fast, nature is slow. That's point 1, about the pace of change. And point 2 involves leverage, the ability to change the system. The lower layers have control. Governance determines what infrastructure looks like. Infrastructure determines what business sits on top. This model helps us understand that we're living in an era of unprecedented disruption. Why? Because in the last 30 years, we've seen a wholesale change out in the infrastructure layer in society with the emergence of the internet and the cloud. And we can also use it to look at companies. For example, we really like it when a company moves from being in the business layer to infrastructure, like Amazon has done. It's invested in logistics and cloud computing to basically have other businesses build on top of it. And that brings leverage. It's also helpful for understanding what's going on in the world today. For example, Meta's recent announcement that it's getting rid of all its fact checkers and moving its content moderation team to Texas is all about the anti-woke culture and the Trump presidency influencing infrastructure. So let's think about technological change, something that has driven the returns of both Tesla and Nvidia into the Mag 7 recently. Isn't it hard to analyze? Well, we need to analyze it so that we can identify the next Mag 7, the next mega caps of the future. The only thing we can do really is think in probabilities, but there are some patterns that you can follow that are quite helpful on this. If you look at interest rates, it doesn't really tell you what the market's going to do. But if you truly understand the impact of Wright's law here, which is where the cumulative doubling of the production of something has an associated reduction in cost, or if you understand Jevons paradox, where there's an inverse relation to when the cost falls by half, quantity of demand more than doubles. If you can understand that, you can make predictions as to what's coming next. So 10 years ago, when we were analyzing Tesla, there were some predictions we could make with a high degree of confidence about the energy density of batteries, the cost of onboard computing, and the power of software. Wright's law here dictated that as Tesla made more vehicles, it would be able to do so more and more efficiently. And Jevons paradox dictates that those cost declines and increased energy efficiency would have a disproportionate impact on demand. Today, the Tesla Model Y is the best-selling passenger vehicle in the world. And in case you think that's backward looking, I'm going to stick my neck out here for you all. So when I come back in 10 years' time to do this next lunch, you can hold me to account. I think it's obvious that autonomous electric aircraft will be with us in the next 10 years. Secondly, I think it's obvious that battery storage is going to be a much bigger component of our electricity grids. And so already those are investment ideas for the next mega caps in a decade's time. And finally, we think it's obvious that efficiencies gained by deploying AI won't merely compel us to consume the same amount for less money, but will rather, following Jevons paradox, trigger a monumental increase in the consumption of data, of software, of compute. There is almost unlimited demand for intelligence, and the pace of deployment will likely be limited only by the cost of supply, which, if Wright's law holds, will fall significantly in the coming years. So there are huge investment implications in this monumental change. Touching briefly on AI then. I noted NVIDIA's recent success wasn't the result of interest rates or an election. It's a system-wide change. On Wall Street and in the markets, the AI discussion seems to focus solely on NVIDIA and the Mag 7. But there are many other places in the AI hardware and software stack that are available for investment. So whether that be infrastructure companies like Nvidia, Amazon, or Cloudflare, to apps like Roblox, Duolingo, that bring a step change in user experience, or those creating proprietary data assets to unlock new intelligence like Samsara in the Internet of Things, or recursion in health sciences. And we're seeing AI impact even old inverted commas companies like Meta. It's WhatsApp and Instagram and Facebook Messenger platforms connect 4 billion people a day, and it's deploying AI tools to enable businesses to respond to customers through click-to-message ads. It's also increased engagement time on the Facebook platform by 8% for 1 billion users. That's hundreds of millions of more hours of advertising opportunity. But looking beyond technology, what change is going to happen over the next decade that could drive the mega caps and the next Mag 7? Well, it's not just limited to tech. We engage regularly with alternative sources of insight, one being a leading anthropologist in the US to study big changes taking place in American culture. How are they altering behavior? What will be more lasting and more powerful than people think? And what implications are there for markets and companies? And these studies, I could do a whole hour-long presentation on them on their own, but just to name a few, the importance of sleep, which has led us to invest in a company called Inspire, which helps with sleep apnea. The great outdoors and the value in scarcity has led us to invest in the likes of Yeti, which makes outdoor products. And conscious consumption has led us to invest in Lemonade, the insurance company, using behavioral economics. So this is the American Fund portfolio today, and the monumental changes it's addressing for long-term growth. Innovation and disruption have been a consistent feature of the last 2 decades. First came the internet, which connected the world's computers. Then came mobile, which helped democratize access to this web of computing power. And throughout this period, we saw the power of these technologies drive change in industries and in stock markets. Amazon disrupted the bricks and mortar retail landscape. Netflix emerged as a powerful force in Hollywood. Investors who backed these innovators were handsomely rewarded, and those invested in the incumbents often suffered stagnation or worse. Now we stand on a precipice of this another period of massive change. It could be the most disruptive of all. The internet increased activity, mobile drove availability. Generative AI is making computers smart. The technology is already smarter than humans at some tasks and is continuing to improve at a rapid rate. This Gen AI revolution will compound on top of others which are already underway, shown here in this slide, in areas such as transportation, electric vehicles, power, renewable energy and batteries, and in the commercialization of space. So it's not hyperbole to say the world is about to change in dramatic ways. So investors must think carefully about how they navigate this and be wary of the illusion of safety in a top-heavy index. Some of the largest companies of today may successfully navigate this paradigm shift. Some will not. Many won't. So we believe our approach of seeking exceptional growth companies is a great way for investors who wish to not only navigate but capitalize on this technological revolution is the way forward. We own what we believe to be some of the most exceptional growth companies in America. They're ambitious, innovative, and long-term orientated businesses with strong, adaptable cultures. These are the companies that we believe have the vision, the organizational ability, and agility to navigate the next 4 years with President Trump and drive change. These are the companies that we believe have the potential to be market giants of the future. To conclude, passive index funds are here to stay. They're a great innovation in our industry, but it's more important than ever to pair genuinely active managers with passive exposure. The American Fund stands apart from the market. And like the communal nest of ostriches, where careful tending leads to the emergence of extraordinary survivors, we think we've built a distinctive collection of companies at earlier stages of their growth journeys. And while only 15% of ostrich eggs successfully hatch in the wild, those that do become the fastest or some of the fastest creatures on Earth. The data show our odds of success are much higher than those of the ostrich. The American Fund portfolio companies have strong financials, visionary leadership, and exposure to transformational trends. They're positioned to become the mega caps of the future. The market's focus is on concentration, valuation, interest rates, and geopolitics. Against this backdrop, our focus remains on identifying and nurturing tomorrow's exceptional growth stories. As history shows, the greatest returns come not from following the herd into today's largest companies, but from spotting tomorrow's winners before their potential is fully recognized. Thank you.
Thanks very much for that, Ben. Some really big talking points there, and you took us through a lot of areas, you know, all those big areas that big questions investors are thinking and talking about at the moment. I'm conscious of time. We do have quite a lot of questions here, so I'm just going to fire some off to you, and we'll try and whiz through as many as we can in the time we have left. So you mentioned obviously about volatility as part of the presentation there, and talked about Trump, but it's probably understandable. We've got a few questions around the regime change there and what that might mean. So we've got a question here. Do you think the markets will be particularly volatile this year with the inauguration of Trump, or will we see growth from the US?
Yeah. I think the markets are more volatile than they have been historically. That's because of the concentration of the index, but also because of the increase in technical machine traders. There seems to be a faster and more reactive market to minimal news. There is indications that Trump's policies will be growth positive. He likes to measure his success on the stock market, so one would think that he would like to keep that positive. Some of the potential plans that Musk and Viraswamy are planning in the Department of Government Efficiency could be hugely deflationary. So I think we don't know is the honest answer, and we have to go back to companies that are financially resilient, addressing big market opportunities and structural change so that they can endure short-term volatility and thrive over a 5 to 10 year period.
And we've got a question here about your thoughts on Elon Musk and his current tweeting and involvement in politics. Is this a distraction from the task?
Yeah, well, let's look at Tesla. Tesla's faced significant challenges, both in scaling vehicle production. It's a capital-intensive endeavor with substantial financial and operational risks. And through Elon Musk's public persona and statements, it's managed to do that. The close association between sort of Tesla's brand and Musk presents occasional risks that require careful evaluation, particularly given growing EV competition. But his leadership has been crucial in navigating critical periods. So we know that investing in Elon Musk companies means taking everything that comes with Elon Musk. The recent bout of tweets is undoubtedly really challenging, objectionable. We don't believe that engagement outside of our sort of established pattern of discussions with the board would improve return for shareholders or stop him doing it. But we have been making sure that he's still involved with, actively involved in day-to-day decisions, which he is. We met recently with Chairman Robin Denholm, for example. She's an effective chair at Tesla and has brought a lot of stability at the company. So obviously we prefer him to tweet less, but we've actually reduced exposure to Tesla, notably in November. And so it's still a top 15 holding, but something that we've reduced over the last year or so.
And what was that reduction that you made?
We took out several percent out of Tesla.
Yeah. Okay. And we've got a question here. Do you believe small and mid-cap companies will perform well this year? I presume in relation to the US there.
As a bottom-up stock picker, I don't know. I know that some will. I know that some will perform well in terms of their fundamentals, but their share prices might be impacted by sentiment. And this is the that going back to that chart of the interest rate that was delivered and the forecast of what it was going to be, no one knows. What we do know, though, is that whatever the interest rate cycle, whoever is in charge at the White House, whatever the geopolitics, over the last 40 years, those companies that deliver the top earnings growth quintile or revenue growth quintile deliver the top quintile of returns. And if you can exploit that, which is what we try to do, you should outperform. The general sentiment that we're hearing and reading about is that because the market's top heavy, the smaller and mid-cap names should perform well. But it's quite hard when some of these massive companies are hoovering up so much economic activity. This is why we go on a stock-by-stock basis and only hold 45 companies.
Got a question here, again, something you were talking about within the presentation, but what have you done to protect against the huge savage drawdowns that shake client confidence?
Yeah, so
learnings, I suppose, from performance.
Yeah, so as I mentioned in the presentation, the volatility level we delivered was beyond what we and our clients expected over the last 4 years and higher than we would expect in the future. So we've done an in-depth review over the last year with our external risk team and some large institutional clients to assess what happened. And the outcome of the assessment was that volatility in the fund doubled, in simple terms. Half of that volatility came from the market being more volatile, and half of it broadly came from our investment decisions. And it was about the extension of the duration of the portfolio. So higher growth companies where their profits were further in the future that were naturally more susceptible to interest rate changes. So we have brought in these guidelines that will, in the future, serve as checks and balances for those measures in the portfolio. So we have a minimum now of at least half the portfolio by weight in certain maturity of financial characteristics on a trailing 3-year basis. So if they drop out in one of those 3 years to being unprofitable, for example, they drop back to being a lower level. So at the moment, over half of the portfolio is in companies that generate EBITDA or net income or return on equity of over 15%. We've also brought in concentration rules on the sources of demand. That Euler diagram, the circles of where the money's coming from, we're not going to have any more than 25% in any one sort of source of demand, whether that be advertising or electrification, transport, or healthcare. And thirdly, it's the type of growth. So we have about 2/3 of the portfolio in these transformational, explosive type growth companies. But our exposure to the enduring high growth companies like Amazon or Meta or Netflix actually declined in the past 4 years, result of perhaps the nature of what was happening in the market. And so we're going to maintain a minimum exposure of 1/3 of the portfolio, at least, to these enduring high growth names that are less volatile, but still compound at 15 to 20% per annum. We're also making a cap of at least at most 5% at time of purchase in the companies that are at the earliest stage, unprofitable or no operating cash flow. So those measures are in play now. They've served to reduce volatility in the portfolio back to pre-pandemic levels and will kick in should volatility in the market pick up.
Great. Well, thank you so much for taking us through that, and thank you very much for your questions today. I'm conscious of our time here, but I'm sure Baillie Gifford, Ben, and the Baillie Gifford team will be happy to answer any other questions that you may have if you wish to contact them. So yeah, before we wrap up today, I'm going to go through the learning objectives again, which you should be able to see on the screen. So by the end of this session, delegates will have learned the potential risks of investing in a concentrated index, why and how Baillie Gifford's American Fund seeks exceptional growth companies that could be the mega caps of tomorrow, how this approach can help you manage your exposure to a vitally important but top-heavy market. So thank you again for questions. Thanks very much to Ben for his presentation. Again, I'll remind you we should be delivering your CPD tomorrow. But just before we close, let me leave you with a teaser of what's to come from professional advisor events in the first quarter of 2024. Next Wednesday, we're hosting the next in our working lunches. This is going to be this time with Orbis. Their new head of UK retail, Matthew Spencer, will deliver a presentation, Risk and Return from the Bottom Up. If you haven't seen this presentation before, it's really worth an hour of your time over lunch, especially around that big question of how to diversify portfolios. And in February, we're on the road again, this time with a subtle change to our Q1 multi-asset roadshow, which has been renamed the Multi-Asset MPS Roadshow. So that's going to start at Alton Hall in Leeds on the 4th of February, and then Warrington on the 5th and Coventry on the 6th. And the following week will be at Lee Court in Bristol on the 12th and finishing in London on the 13th. And there'll be 6 presenters at this event: BlackRock, Clever Advisor, Morningstar, Momentum, Orbis and Quilter Cheviot. And our keynote speaker will be De Facto's Insight and Consulting Director, Paul Tinkler. Then on the 19th of March, we've got 2 events for you. At lunchtime, we'll be back with another digital working lunch. This time we'll be joined by Hamish Maxwell. He's investment specialist with the Scottish Mortgage Investment Trust. And then on the evening of the 19th of March, we'll be returning to the brewery in London for our annual Professional Advisor Awards, where over 500 of us will gather to celebrate the very best in our industry. And a key feature of these awards is the reveal of the UK's best financial advisors to work for. So we look forward to seeing you all there. So all in all, that's a total of 5 hours of CPD over the next 10 weeks, as well as a fantastic night out with the industry. And as ever, if you wish to get more information or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. So that's pretty much it from today's session. Thanks very much to Ben again for joining us, taking our questions. And thank you very much for your company this lunchtime. We hope you found this session helpful, and we hope to see you again very soon at another Professional Advisor event. Goodbye.